Well, hello there, my friends. Chris Marcus here with you once again for Arcadia Economics as we start off another trading week here in April of 2023 with plenty going on in the financial markets as always. So fortunate to be joined by Vince, the Professor Lanci of Echo Bay Partners, Goldfix Substack, to talk about some of the recent developments as we have gold and silver lower today following Friday's labor report and a whole host of other things going on. So first of all, most importantly, Vince, welcome on in. Great to have you here again, as always. And how are you doing today, my friend?
Thank you for having me. I'm doing well. Hope you had a good holiday or are still having one. And yeah, I'm happy to be here. Let's get going. I want to do a book review too, right?
We have another book review. Vince, you're addicted to reading central banker books from the Federal Reserve. Last week we had Janet Yellen. Today we'll get your thoughts on Ben Bernanke's book. So always fun to check in on that. One quick note before we get started, we'd just like to thank Raina Silver, who brought us today's video. And Raina Silver, who is exploring 3 high-grade district scale assets, 2 in Mexico and 1 at Medicine Springs in Nevada, where they did have last year's drill results out recently, and they continue to get indications of what could be a carbonate replacement deposit there. The first hole they cut was 1,021 grams per ton of silver over 2.4 meters. And they also drilled a 1.75 kilometers to the southeast in the previously undrilled Silver Butte area, where they came back with 186 grams per ton silver plus 3.7% lead and 1% zinc. So you can find out more about that at Raina Silver. Link is also in the description field below. And thank you to Raina, one of the companies that hopefully will be able to find a nice silver deposit in an environment where silver supply getting on the lower side. We have the deficit going from last year. And as I'm sure, Vince, you'll touch on in today's call, we continue to have a lot of volume at the retail dealers as well. So a lot going on, but first place I wanted to start was with the reaction today in the gold and silver price following Friday's labor report. Markets were closed on Friday, and taking a look at gold, we see after it got up to about $2,040 in the futures contract back late last week, it's now trading just over $2,000 an ounce at $2,005. And we take a look at silver, just under $25 an ounce. Look at the Kitco charts. We can see it dipped on the open, then was about flat for a couple of hours, traded lower during the night. Then as Europe opened up, was higher, and then saw that pattern once New York opens up. Prices of both gold and silver down. And I will just remind people the labor report from Friday did come in at 236,000 jobs. We'll take that with a grain of salt, as that is the government figure, but came in right around expectations, suggesting that we could have more Fed hiking on the way. So Vince, with that said, love to hear your thoughts on the labor report on Friday and the reaction to that we've seen so far.
Well, I want to talk about the behavior last night as well. I think that's kind of important, especially with the long weekend. But starting with the labor report, the jobs number came in slightly softer. Unemployment remained largely the same. The wage growth slowed, so people's income is falling further behind inflation. So inflation may be coming in. We're not sure yet. Let's assume that it is. But your ability to keep up with inflation is not. So pay increases are decreasing compared to inflation. The report itself implied, if you look at the internals, the report itself implied a slowdown. According to the data, the slowdown has just begun. But I think people that are smarter than that, that I listen to, say that the slowdown has been going on for some time. So, for example, if you look at the internals, the jobs number may have been close to unchanged, like a small miss lower, but the jobs are waiters and bartenders. The people not working are manufacturing jobs are being lost, at least currently. And so the internals on the job number were very poor. So that reeks of a slowdown. And that you would think would say, okay, then metals and stocks would go higher. And that did not happen. Well, the markets were closed, as you reminded me. That did not happen. But gold and silver had a nice run up before. But what happened Sunday night, I think, might have been related to Japan more than the BLS. Should I touch on that?
Sure.
Okay.
It did have a statement out from the Japanese central bankers today, or last
Yeah,
night.
exactly. I don't know what the new guy's name is. You know the new guy's name? Can we even pronounce it? At least I can't. Okay,
give me a moment on that one.
Whoever, well, I don't want to, I'm just trying to. The new governor of the Bank of Japan had been expected to announce a more frugal, a tightening monetary policy to offset, to start to get off of the ultra low interest rate policy they've had for forever, and so the announcement today coming out of the JGB was, or I'm sorry, the BOJ was they would not be doing that. They would continue pursuing the easy, ultra easy monetary policy they have, and that happened. When that happened, silver and gold knee-jerked lower again. So you had silver and gold open up lower and bounced violently, right? We had a downtick early on, and then the markets bounced violently. Then there you go. There's the article.
Wada.
Yeah, Wada. I'm sure that's how you say it. There's markets have calmed, and as far as the impact on the Japanese system, we have maintained the easy monetary policy, and there's ample capital and fluidity. Now, the markets, stocks and metals reacted lower, probably to the BLS because it wasn't the jobs number, because it wasn't weak enough. Now that's what they're looking for. They're looking for really cratering jobs numbers to ease again or to stop hiking. And this is actually being interpreted as bearish for U.S. markets and bullish for the dollar. Let's put it that way, because if Japan is not going to tighten their monetary policy, then the yen is going to continue to depreciate against the dollar. That knee jerks the dollar higher, and then you start marking things like gold and silver that are denominated in dollars lower against the yen. Stronger against the yen, lower against the dollar. All this nonsense I'm saying here, all it means is that the market's movement today lower is based on the Bank of Japan's. It's just noise, right? Doesn't mean it can't continue lower, but I'm telling you that this is not like, no one's not buying gold anymore. No one's not buying silver anymore, which we'll talk about in a minute, right? I mean, the physical demand is just ridiculous. And that's just the market being marked in a very thin time frame. Basically, the markets are just reacting to news in thin markets, sort of. But most markets are still closed. So as long as gold stays above 1993, it looks good. And silver just looks good above 2460 to me. But I'm not a technician. What should we talk about next?
Yeah, and Vince, it all surprised just, I keep thinking back, and we'll pull out the 6-month chart where obviously back in, let's go to the 1 year, back in September, we saw the lows in both gold and silver. There's gold, 1,646. So quite a rally since then. And fascinating that we've seen this while the Fed has been continuing to hike rates. Now, I know the narrative is that if the Fed's hiking, gold and silver sell off, which is not historically what has always happened. Certainly for the first half of last year, that was indeed the case. Although, are you surprised that we've seen as much of a rally? 1646, so about $350 in gold, and silver was down at $18. So that's a $7 move.
$7 rally. That's pretty steep. That's pretty steep when you think about it. That's very steep. Am I surprised? Yes, but in retrospect, I'm very smart, right? In looking back, I'm very smart. First of all, I think you remember when forgetting the fact that central banks are buying, forget that. Just focusing on domestic policy, the Fed raises rates, silver and gold should drop, right? Because it's reducing money supply, availability to buy metals, and it's controlling inflation. So it should be bearish for stocks, should be bearish for gold and silver, and especially this is just all good news, especially since real interest rates climbed to positive 2%. Right. So if real interest rates are 2%, even after the inflation, then what you're looking at here is you're looking at, it costs you 2% to own silver in a storage vault. Why would you not just buy a bond? So those things are supposed to drive the metals lower. And, if you look at it in perspective, and I don't have the chart handy, but I've done the work on this, the silver and gold, when interest rates were at 2% before, real interest rates were 2% before, silver was like $18 and gold was $18.50. So look where we are now. We're basing at higher levels. We have higher lows and higher highs, and that's all very good. The thing that I think is giving us the tailwind is the central bank buying. I mean, you need gold if you're going to be a central bank transacting with other central banks, and therefore sovereign funds are buying silver. But that's really not the story of the demand. I mean, physical demand is off the charts. You know that.
Yeah, and in addition, you mentioned the real interest rate, although we're still at negative 2% when I guess back in February, and we'll have a new CPI coming out this week, but they had the year over year at 6%, core at 5.5%, where we have a 10-year yield of just a little bit under 3.5%. So just interesting when these things start to be noticed or start to matter, but still seeing that negative interest rate. And do you think that that's just a reflection of more people becoming concerned about what they're seeing overall, even before the banking issues popped up? Or
absolutely. I think the awareness by the general public, when I was referring to the West, not the East at all, they're already been buying silver and gold for for years. Europe is now a buyer of gold. I don't know where they are on silver, but the U.S. has a taste for silver. Can you still hear me?
Yep, I can hear you. Sorry,
okay, your camera blinked out, but I know you're there. The West, specifically the U.S., has a very large taste for silver. And to answer your question directly, I think because we're in a changing scenario, that correlations that we're normally used to are not working. I mean, nothing makes sense anymore. Like, for example, I talked to a guy on the point about inflation, the point about raising rates is bearish for metals. Why are metals going up? High positive real rates is bearish for metals. Why are metals holding? What is going on there? Well, I talked to a buddy on the commodity side who works in the grocery industry. He's an executive in that area. And I said, why? And he made a joke. He said, we're going to keep raising rates to infinity, and your eggs are going to cost you $500 a dozen. And I said, what are you talking about? Like, at some point, it's got to kill demand. He said, no. At his level, because he understands these things better than I do, he's saying that on necessities, companies are passing through expenses. Oh, interest rates are up, cost of money's up. Well, we're just going to raise the price of eggs. We're going to raise the price of food. We're going to raise the price of things that are needed or are a hedge against dollar risk. Things that aren't needed, like your fifth color TV, they're not going up. So what he was saying to me is that we are in this kind of paradox where higher interest rates is making people more aware of inflation because the price of things is going up. Simultaneously, the bank thing. So I'm buying silver and gold because of inflation, and they've got that under control. It's like, oh, now banks are going under. Now I'm buying it because banks are going under. And what are they going to do to cure the banks, Chris? They're going to eventually, they're doing it now, whether they say it or not. They're going
or QE.
Inflation, right? Exactly. So it's a what is it, a daisy chain or a circle jerk? I don't know what it is, but it's certainly There's no way out except to debase the currency. And they're doing that right now.
Well, that's the answer that I had as well. And I'm going to pull up the probabilities for the next Fed meeting. See, it's now up to 70% that they will do a hike up to a range of 5 to 5.25 in the May meeting that is coming up in just a couple of weeks. So
Right.
if you look at the further out probabilities now, market pricing in that will be the last hike, and pricing in a series of cuts, which would certainly be interesting, especially if we do see 3 cuts as is currently being priced in. One thing I will mention here, interesting report from the IMF, no escape from the zero lower bound for top central banks. And they say here, interest rates eventually should fall back to levels seen before the outbreak of COVID-19, with advanced economies again within sight of the zero lower bound. Though rates are now higher as major central banks battle inflation. When inflation is brought back under control, advanced economies, central banks likely to ease monetary policy, which none other than Jerome Powell mentioned as well. Here is the transcript from his last press conference. This was back in March, and as I've mentioned a couple times on the show, but we'll point out again, the economy evolves as projected. The meeting participants projects that the appropriate level of Fed funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025, which, I mean, here you even hear from the Fed chairman that now he's saying rates won't be going lower this year, but I mean, it seems like a bit of a mismatch that they're going to bring inflation under control. They're also going to bring rates lower.
Right.
And this is quite a juggling act, it seems like.
It's an eat your cake and have it too moment. So leave that up there. Let me read that specifically. If the economy evolves as projected, it's not, but let's assume that it does. The meeting participant projects that the appropriate level of Fed funds rate will be 5.1 at the end of this year. Okay. 4.3% at the end of 2024. Okay, so they're saying, I'm looking at it this way. They're going to get it to 5.1, let's say in May, and then go flat between here and the rest of the year. And then they're saying that they'll lower it about 70 or 80 basis points in 2024. And then they're saying they'll lower it another 120 basis points in 25. Now, smarter economists than us, I'm not an economist at all, Michael Hartnett, he's like a zero hedge favorite from Bank of America. He thinks we got about 1.25 to 1.5% drop in rates after we hit the high here. He's saying that something has broken, and that something that has broken has been the banks. But those banks have been fixed; they've been made whole. But what you have now is a commercial real estate market that is running on fumes, and there's no money out there now. So the banks don't have money to service their loans anymore. So they can't do new loans. Therefore, it has to go with the bigger banks. And the bigger banks don't do a lot of commercial real estate. So you have an industry that's in zombie land right now, which incidentally, I don't have the chart handy. I'll give it to you afterwards if you want to show everyone. The commercial real estate loan market is the very first thing one of the very first, if not the very first things that collapsed in 2007. Now, I don't like to draw parallels. I don't have the information on, but it is the early warning symbol of an aggressive recessionary real estate collapse. So be that as it may, if the Fed thinks they're going to hold it, interest rates at 5.1% till the end of 23, I'll take the under on that. I think they'll lower 50 to 75 basis points. Michael Hartnett thinks they're going to lower it 1.5 to 1.75. So, and he hasn't, mind you, he hasn't been wrong in 2 years. So I'm going to go with him.
All righty. Well, it's almost like, what's the point of raising it up as high as as they're going if they're just going to take it lower? I mean, I guess there's the outside chance that this cuts inflation down. But if it cuts inflation
It's
down
hard
and
to
then you
do.
lower it again and you kick inflation back up and start quantitative easing to cover treasuries and banking issues, then
Yeah, it's they got their foot on the gas and on the brake at the same time. The car's not going anywhere, right? Right. The tires are burning up, the brakes are on fire, and they're wondering why either the economy breaks or inflation goes to the moon. It doesn't matter. Either the car lurches forward when the brakes fail and we slam into a wall with inflation at 10%, or the market or the brakes hold and the tires blow and we don't move. Your analogy is the car analogy, and that's exactly like what you're describing. Why raise rates at all? That's what you said, right? Why raise them at all if you're going to lower them? And that's the thing. It's like they have to justify their job. You know, we did it, so we said we could do it, so we did it. You know, don't fire us. I don't know. I did a paper on this on this today. Not a paper, but a report. The Fed has created. The Fed has, Chris. I'm sorry, I have to go off on this. The Fed has created volatility since 1987. The Fed has created volatility since 1990, since 2000. The Fed volatility in the decade of the big crash in 1987 was about 0.81 standard deviations. That number doesn't mean anything to us as laymen, but it's now 1.2. Like the Fed's existence has created volatility. We were less volatile during the financial crisis associated with the oil embargo and less volatile during the 1987 era crash than we have been since 2012. What do they do except mess everything up?
Well, speaking of volatility created by past incidents, again, I know you're a big Ben Bernanke fan over there, and going to pull up, this is Ben's wildly exciting op-ed that he published back in November of 2010, which was right after they launched QE2, and he was talking about what the Fed did and why. My favorite paragraph from this, I'll read this here, and then you can share your thoughts on Ben back then and also as well now. It says this approach eased financial conditions in the past and so far looks to be effective again. Stock prices rose and long-term interest rates fell when investors began to anticipate this additional action. Easier financial conditions will promote economic growth. For example, lower mortgage rates will make housing more affordable and allow more owners to refinance. Lower corporate bond rates will encourage investment, and higher stock prices will boost consumer wealth and help increase confidence, which can also spur lending. Increased spending will lead to higher incomes and profits that in a virtuous circle will further support economic expansion, which on one hand sounds great. Obviously, we're seeing what happens when you undo even a fraction of that. We saw the same thing back in 2019 when they tried to undo a little bit of that. And where does that leave us now?
Well, I mean, back then, 2010, 2011, I thought that QE meant instant inflation. And I was wrong, right? Many of us were wrong because to paraphrase John Paulson, we underestimated the Fed's power to route money where it wanted to go. And that's what happened. They throttled money going to this asset and encouraged it to go to that asset. What's different this time is, let's say he said that again. Let's say he was the chair again and said that again. The difference is half the world doesn't trust the dollar anymore. So when you trust the dollar and you need dollars, printing dollars is like, oh, it's precious, to use the word. I want this because I need to pay my bills. But there's a certain point where you print too many dollars, people say, wait a minute, these aren't solving my problem, they're causing my problem. So it's kind of like liquidity is how you pay your bills. But when there's too much liquidity, meaning too much printing, you're drowning. People are drowning in dollars. If not in the actual physicality of the dollar, meaning there's too many of them out there, they're drowning in the sanctions and the rules and the onerous behavior that comes with them. And so that philosophy that Bernanke had, that virtuous, anytime someone says virtuous circle, Doesn't he say that there? Virtuous circle, virtuous cycle. That's Ponzi scheme, right? Right. We're manipulating market participants to put their money where we want them to put it. And as long as we keep doing this properly and you still want the dollar, it'll work. But if we do that and you don't want the dollar anymore, well, that's a shit show. It's not going to work. And that's where we are now. So it's not going to work anymore. And they know it.
Well, I think there's a good case to be made for that. And actually, we have some questions coming in. Then let me pull that up. Urban Sombrero says, will there be a rationing of silver to retail when scarcity gets crucial? And I want to pull something up here. I don't know that I would call this a rationing, perhaps, but we're seeing signs of, I think what he's getting at, or he or she is getting at. Here's SD Bullion. Minimum order has temporarily been set to $500. Money metals, high volume alert. Please expect 4 to 5 days in additional shipping time. APMEX, temporary 250 minimum order is now in place. I think this is more towards bottleneck in processing and get it out rather than a case of running out of silver just yet. But I mean, if this is what happens when the order flow becomes overwhelming, just from a processing standpoint, not unreasonable to expect that might be the case. But Vince, any thoughts on that one?
Yeah, I mean, this is an area that you know a lot more about than I do. But I can add this. I've seen this before. These messages, people are interpreting them. I want to say this. There are people out there interpreting these messages as they're running out of silver. We don't want the small guy's business. No, that's not what's happening. I saw this in 2011, and I saw this in years before. And that's basically they're buying wholesale to sell retail. So they're buying wholesale, and then they're selling retail. Well, the problem is they can't probably, I'm not speaking for them, but they can't get small orders. So it's kind of like, they have to take big orders, and they don't, these companies did not make money for years. They were selling at spot. Remember, APMEX was selling at spot and giving you like 10 ounces or something like that back in the day. And just to open the account. And they've staffed down. They don't have 1 million people working there anymore, and now we've got this, it's almost like a surprise. Like, you have a surprise in flows, you had a holiday weekend coming up, and you have demand that's been resilient, if not growing. That's information that I can confirm is true over the last 6 months. And going into this weekend, they're not turning business away. They're saying we have to satisfy the big orders first. There'll be stuff for the smaller orders as well. It's a bad. I don't know a lot of these firms, but I know 1 or 2, and I know that that's standard professional operating procedure when you're trying to, what's the word you use? Bottleneck. That's the word used, right? That's the bottleneck concept, right? If you've got, 1 million people that want to buy one coin, and you have one person operating a phone, well, that's a problem. If you have one person who wants to buy 1 million coins, you're going to take care of that because you have the metal to go right away, and then you're going to handle everyone else. It's a staffing thing. It's a holiday thing. It's my understanding. I've seen this before, and it's not a negative. But that said, to those people who think there will be rationing, I think what you're probably going to see down the road, the alarm for that, just from my experience, is the smaller dealers will run out and not get refilled. Okay, the bigger dealers will remain available, and that's because the smaller dealers won't have the cash flow to take down a bigger chunk, and there won't be rationing per se. There will be a flight to quality among dealers. That's how I look at it, and I've seen that before. I can say that from experience.
I think that makes a lot of sense. And Vince, before we get to the next question coming in from Mickey, perhaps you'd like to show, I know we switched topics from Ben Bernanke, but he's so darn exciting. And I know you were.
Well, let's answer some questions, but I'll just throw this on in the background. Does that work?
Okay. Vince did video of his book review of Ben Bernanke's exciting new book that came out. Or actually, geez, it's been out for almost a year. So,
Well, this was your recommendation, Chris.
I knew you'd like it after you had so much fun with Janet's.
It was
Are
hot.
are you going to pull your video up there, Vince?
Oh, should I do that?
Sure.
Yeah, basically, Chris was like, why don't you do Ben Bernanke's book next? And I'm like, sure, I'll review that. And it's, well, you can see for yourself.
I knew you couldn't put down Janet, so I figured what else
Exactly.
do you do after that?
So I'll click on play, I guess, on that. But what's the next question that you had there?
All right, the next question from Mickey. A question for Vince. What is his outlook on the recent news of de-dollarization for multiple countries, which seems to be coming out by the day of, I guess it was Brazil and China last week making arrangements to go without the dollar. And I mean, we see whether it's Saudi Arabia or Mexico, I mean, it's almost on a daily basis now. We see countries either interested in joining the BRICS. So your thoughts on the de-dollarization as we see your thoughts on Ben Bernanke's courage to act.
Yeah, the de-dollarization is real. It's ongoing. It's not going away. But right now they're talking about it too much. Factually speaking, it's really hard to take things seriously when everyone's talking about it. I'm a little bit suspect. I feel like the rug is going to be pulled. No, the rug's not going to be pulled over the next 6 months, 1 year, 2 year, 5 years. The rug's going to be pulled for a week or so. But the reality is, if you want to look for patterns in the press, look for this. 6 months ago, we were talking about, Ghana might sell oil for gold or buy oil and use its gold. Like, okay, that's Ghana. That's a shitty little country. Who cares about them? Well, it's not a shitty little country, but let's just give you that, right? And then you hear Brazil is talking about something. Then there's a product called M-Bridge is coming out, and then there's the Russian and Chinese, de-dollarization, which is all in the news. But now you're hearing Western countries talk about it. Macron goes to China and basically says he doesn't want to be long dollars anymore. Now, whether you think it's BS or not is irrelevant. You don't speak out like that against King Dollar in the presence of the US, but he did. So this is real. What I'm waiting for is, I have to be honest, I'm waiting for the pushback that destroys precious metals that allows us to get in it and cheap again. Because this isn't stopping. You're going to have a multipolar world. The dollar will remain, you may not hear this from many other places, the dollar will remain the acknowledged reserve currency in the world. Dollars will be accepted everywhere. But for nations dealing with each other on commodities, it will be increasingly gold and silver, silver's coming, that they deal with them because they want to have money that backs their currency more solidly than just promises. I'm dealing with your country, you're dealing with my country. We're not using dollars as trust anymore. I'm going to use yuan, you're going to use rubles. You know what? How much gold you got? How much gold do I have? That's how it works. That's what's going to happen at the international level. I've said this phrase a million times, but it's mercantilism. And the dollar will drop. You can take this to the bank. The dollar is going to drop 30 to 40% against raw materials over the next 5 years. The dollar will hold its own or probably get stronger against the euro over the next 5 years. The yuan and the yen are going to increase over relative to the dollar by 30 to 40%. That's what's going to happen. Is it going to happen tomorrow? No. Are there going to be violent pushbacks? Who knows? Maybe there'll be a war too. An invasion that makes us have to buy dollars even more. But are you going to sell gold? Are you going to sell silver if there's another war? I don't think so. So to answer your question in brief, it's overdone right now. They're talking about it too much right now. I mean, come on, mainstream media is talking about it right now. When I see a Barron's headline that says gold's just getting started, I don't want to buy gold, right? But when I see 3 mainstream media news stations discuss the demise of the dollar, they got permission to do that. You don't just talk about that without checking with the government. And that I view as a signpost. There's a There is a seal that has been broken that has been made it more permitted to talk about. So it's real. It's not going away. And, Luke Roman explains this academically better than I do. And the bottom line is the dollar is going to go down. The British pound is going to go down. The euro is going to go down even more, I think. And the yen and yuan are going to go up. So for Westerners, that means if it's a commodity, it's going up 30 to 40% in price relative to the dollar over the next 5 years. You can bank on that. And that means silver is going to go up that much, at least.
Yeah, and it's interesting because even with the global de-dollarization, we continue to see states adopt new bills to have gold and silver be used as currency or reserves. And
right
here recently, Texas moves to create gold-backed digital currency. So
right.
Interesting to see it's happening in the US as well. It's not even just a foreign thing anymore. And
I think that's actually really important. It's the grassroots that determine the money. Governments don't say this is our money. What happens is the people determine what the money is and the governments adapt. So what you're seeing at the state level, each state is saying, we're going to make gold and silver more acceptable. Eventually, it becomes a national policy, and you're going to see that. Absolutely.
All righty. And going to see if we have some more questions here. Frickendale Special says, when do the miners hit all-time highs? Obviously, we have a ways to go in a lot of the mining stocks right now. I would think that it would take a bit more of an issue perhaps in the banking sector. Maybe once silver starts passing 30, that we actually see a bigger movement. It seems as if people are still happy that gold and silver have gone up, although I think even the tone within the gold and silver community is like, okay, but is it going to be smashed back down tomorrow? And I would imagine it might take also in addition to the bullion price rising higher, getting mainstream participation from some of the regular funds starting to go into the gold and silver stocks, and that's what would push things higher. And not sure we're there yet, but conceivably, let me put it this way, that if we do get a Fed funds curve that looks something like this, and we actually do see rate cuts play out like that, almost every meeting they have it priced in here. Perhaps that could well be it. Again, with gold over $2,000, getting up to 2040 last week, has come back down. I think there's a degree to which there's some marketing value in there, where once gold's over $2,000, people are talking about it again. I continue to feel like $30 is that line in the sand for silver, and I don't know that we're going to see all-time highs in mining stocks at $31 or $32 in silver, but I think that I don't think it's a linear curve, and that it's more as it becomes a bigger event and a bigger story when other people start thinking, oh, maybe this is something that I need to participate in. And I could see it happening quickly, some stair step like moves at some point. But Vince, any thoughts on the miners?
The only thing I want to add is actually echo what you just said. The last thing you said, because of inflation, because of the banking crisis, there is now a raised awareness. And that means, without talking about the miners specifically yet, and that means the dip to buy is going to be in miners and metals, not in stocks anymore. Look at what's happening in the metals themselves. The metals are going up, and then there's bearish news for everything, and the metals are unchanged, and stocks get hit. About miners specifically, now I'm not a mining person, but I'm drilling down on that now. I'm actually in the process of reading your book as well. By the way, just to digress, the forward is really interesting because there's similarities or parallels with your epiphany moment. With the how does that work again? What is your buddy said? Loaf of bread's going to be $11. That's kind of where you had your moment. I'm like, yeah, I had one of those. Like, it wasn't $11 bread, but it was the same idea. But I'm sorry, back to the miners. The miners are off their lows now in a healthy way. I don't think they're going back down there. and I'm actually looking to possibly buy some miners, and I'll talk to you about that off the air. I don't know which ones yet. I don't want to just buy an index. I did it last time, but I think the miners are lagging the metal for multiple reasons. One of which that I think is not being discussed enough is that if you go back and you look for the parallel with the 70s and the 80s, energy was cheaper and the miners rallied first. Energy is more expensive now and the miners are rallying last. I think the cost of production is important for things like that. I'm not really that sure about it, but people who know about it more than me said that, the cost of mining is a lot higher now than it was at the beginning of the last rally. So maybe it has something to do with it too.
Yeah, the mining costs have gone up quite a bit, especially with the inflation of the last year. So it has made things certainly a bit trickier. And although it's interesting, has that bit of a self-reinforcing cycle where, we're already in a deficit. People aren't launching, companies aren't launching new projects. So it's not as if the supply is set to be expanding wildly. And
Yeah.
Again, I think seeing the price rise will have of the underlying commodity, both gold and silver, will have a lot to do with that. Last question, Vince, that comes in. Any opinion on what we see here of Iran recently looking to explore a cryptocurrency backed by gold along with Russia? Any particular opinion on that one?
Yeah, I mean, there's a lot of headlines like that out there now, and they all seem to be variations on something, whether it's cryptocurrency backed by gold, stable coin backed by gold, or national sovereign wealth funds buying silver and gold. What's going on is that's a public announcement. This is the behavior that's going to happen. So, for example, let's say there's three countries. There's Brazil, there's Russia, and there's Iran. Okay, each country right now, they basically have figured out they cannot create a basket of commodities. They cannot do it efficiently. Like you can't put oil and natural gas in a basket because of the preservation of it and what have you. But you can do it with precious metals. But no one, this is the bad news, right? No one wants to say we're using gold, we're using silver to trade with Iran. I'm in Brazil, right? To trade with Iran, to trade with Russia. Everyone wants to use their brand. I want to use the Brazilian, the real, right? I want to use our currency, right? And Russia wants to use their currency. But all these currencies are paper versions of what's underneath, the gold. So all these currencies are going to be gold-backed currency. So crypto is not the issue. Crypto is the marketing tool. And I'm not saying it's irrelevant. It's extremely important. But crypto makes it easier for Iran and Russia to trust each other, or Iran and Brazil to trust each other, because the blockchain concept allegedly will make the gold harder, or silver harder to miscount, so to speak. So all these little things. This is the death of a thousand cuts. Russia and Iran. Here, I'll give you the real headline. Russia and Iran explore joint launch of joint cryptocurrency backed by gold. Okay, Russia and Iran are creating a new product, and that product will be I don't know what the Iran currency is. Do you know? Riyadh or something like that?
I believe so. I'll look that one up.
That's the Saudi, right? What's the? Okay, so it'll be the ruble Riyadh, whatever it's called. It'll be a hybrid currency, and it'll be a weighted basket with 50% gold, 50%, economic policy. But you can't. We see so much of this that we think we're numb to it now. But a year ago, nobody talked about this at all. It's not going away. It's happening. The whole Bretton Woods thing is happening right now. So, is there a play on that? I mean, I think people are looking for scalpel beat plays. Like, I want the thing that does this. Forget that. You just want to own the metal. Just own the metal and you'll be fine. That's what you need to do. Oh, it is,
Right?
it's not the real, right?
And it is the real the official currency of Iran? And I know we said last question, although I did see another interesting one that popped in that I'll comment on, and also be great to get your thoughts. Tears for Beer says, "Hey Chris, I sell puts on First Majestic on the dips. Is that stupid to you?" Certainly, if we're going to be talking at all about options, I'll give disclaimer: not financial advice. Trading options highly risky. Although I don't think it's by any means stupid, and something that can be profitable. And I guess what he's getting at is, for example, when First Majestic shut down Jarrett Canyon a couple of weeks ago, the stock was down 25%. So if you sell puts at a time like that, again, obviously, if you're selling puts or calls, you're open to the possibility of an open-ended loss that can accelerate. So just everybody watching, to be clear that there is risk to that. With that said, one thing that I've thought about quite a bit in the past few years is the way that the volatilities adjust when you have a move like that, which, how to phrase this, it's almost like a lag in a sense that is a mispricing and can work in his favor. And what I'm getting at is that when you have the stock move down, the put that was far out of the money now is closer to the money. So just due to that factor, that puts more expensive. And also, when something is moving down, that's when the volatilities get really jacked. So perhaps an inverse of that is that sometimes, let's say the stock goes down 4%, and people are wondering, should I buy puts? Well, you can, but the thing is, now the only way to win is if you get another huge move down. Because if you did it beforehand, then let's say the market was flat on a Friday, you bought your puts, then it opens much lower on a Monday, you're capturing that move to the price lower. But also, when it's lower, that's when the volatility gets jacked. So it's pricing in future volatility, a future big move. So if you buy that put when it's a lot lower, you're paying a really expensive rate that you kind of need another huge move. If it goes down a little bit, you might be just hoping to break even. If it stays flat, you're going to lose because the volatility will come in. So even if the index or the stock doesn't move lower, if the volatility comes down, in the way things settle, kind of like we saw with the banking crisis, when it was in the middle of it happening, the VIX and the volatilities were high. If nothing happens for a day or two, the market calms down, that premium comes in. So it can be something that works out well. And Vince, let me know if that made sense the way I'm explaining. It's a little bit of a complex topic there, but did that come across right?
Oh, yeah. I mean, look, who asked that question?
Tears for Beers.
Okay, so Tears for Beers. Chris and I are option wonks. So that's where we started. So you're talking to the right people. I'm gonna say what Chris said from my point of view, which is going to be the same exact point of view with Chris, but using different words. If you like a company and you want to buy a stock, I'm paraphrasing what Chris is saying here, and you say, I don't care if the stock goes down, I'll buy it at that price, and you sell a put before the market drops, not only are you selling a put that's way out of the money, but you're also selling a put that's basically at lower volatility. Generally speaking, when stocks drop, that's when volatility explodes. When the market rallies, volatility generally comes in. So if you're thinking about selling a put for whatever reason, you want to create a dividend or lower your cost basis, if you like the company, and all options knowledge aside, if you like the company, then you sell the put that you want to sell based on the price that you want to buy the stock in, not based on the premium. Now, if you sell a put naked with the expectation that you'll buy the stock if it goes there, you better have the money to buy the stock if it goes there. Because here's what's going to happen. if you sell, if the stock is trading $50 and you sell a put struck at $30 and the market drops to $30, you're going to get a margin call because you're short a levered option. And that's going to be multiple times, as Chris just said, of what you collected. And on top of that, volatility will be higher. So you're going to have to fork up almost the money that you need to buy the stock anyway. Now, if on the other hand, so you need to have the money if you're going to sell a put. And I'm not against it, but you have to know the business. On the other hand, if you're bearish, if you're bullish a stock, a mining stock, but don't have, and this plays into what Chris was talking about, and that doesn't have, that you don't want to necessarily buy, but you're bullish and you want to collect premium, you sell a put spread. So here's why. You sell an out of the money put, right? This is obviously not advice. This is how I do it. This is how I do it, all right? Stock is trading 50. You sell the 30 put, you buy the 20 put. When the market drops and that 30 put becomes at the money or almost in the money, it goes up in value. But what Chris talked about there is as the market drops, all puts go up in money. So the 30 put will go up by 50%, let's say, right? But the 20 put will actually do better than the 30 put on a percentage basis. So while you will lose money, you will be very well positioned to not sweat it out from a sleep perspective, as well as from a pricing perspective. Finally, again, tying to what Chris said, if you sell a put on a company that you like before the market drops, then you're going to be unable to buy the stock after it drops. So if you say I have $10,000 and I want to buy $10,000 worth of this stock, then put $5,000 aside. This is what I do. You put $5,000 aside and you say, if it gets to this price, I'm going to buy $5,000 in stock. Then you take the other money and you short the put for another $5,000 worth of stock. You want to be able to buy the dip when that stock hits down there. If you sell too many puts up front, you're going to be handcuffed. You're going to be panicked because you know what's going to happen. That stock's going to go down and your idea works, but something else happened. Your bank shuts down. Your mortgage payment doesn't go through because the bank is idiotic. And you're going to be like, what do I do? These panics happen all at once. You need to have some powder dry for things like that. Anyway, but Chris is right. You want to sell the put now, but you also want to recognize that there's a lot more money to make after the company sells off.
Yeah, and fortunately, he does mention in here, let me find that comment, that he's doing that at a level where he is happy to buy the stock. So yes, I think that can be a good strategy. I don't think by any means that's blanket stupid. Again, just making sure that you understand the risk. And I mean, I think there's something to be said, perhaps something you want to model out a bit, but the way we looked at it, especially when I was back on the option floor, I mean, you're looking at it over a series of however many times you're doing that. I mean, on any given iteration, that can blow up or it can go really well, but especially if you have a big move, looking at it in terms of, if I did this 10 times, how much would I come out ahead or behind? And certainly, especially when you do get a big move down, that can be a sweet spot once the volatility gets jacked, and it would imply having to have another significant move down.
But know that doesn't happen, right? Eventually it's like,
usually it doesn't, although I guess with the First Majestic example, it was down 16% after hours. So let's say you had a way to make a trade then, it ended up being down 25% the next day. So depending on when you put that on, now if you had sold the put when it was down 25%, then puts would have been really jacked and you would have come out ahead. So obviously we don't know when the end of a move is, and in that case, from 16% to 25%, there was another big.
But I think to your point, if I can interrupt, to your point, don't do it all at one price. You're talking about repeating a concept. How many times am I going to do this? Okay, great. Let's say there's not 10. Let's say he doesn't have 10 companies he wants to do this with. Or let's say he doesn't want to do this 10 months in a row. Let him do it on 10 trades as the market's dropping. You know, it really is about statistics. And I think you're right about that. It needs to happen that way.
Yeah. The main thing is that when something is down a lot, that's when the vols are jacked because the market's panicking. So if people want to buy those puts, they're paying up a lot after the move has already happened. So hopefully that helps a little bit. And with that said, we're going to start wrapping up for today, although Vince, I did want to thank you again for joining us, and also let people know they can find your great research and writing at goldfixsubstack.com. I see we have your site up here, and where you cover things on a daily basis. And I sure enjoy getting your emails, and great way to stay up to date on the market. And anything else you'd like to pass along that to Goldfix Substack?
Well, I mean, thank you very much. I'd like to pass along to people listening now. Throw a book that you'd like us to review. We'll do that for you. We're taking requests. You know, it doesn't have to just be Ben Bernanke. We can do, there's a lot of people out there that need their books reviewed. We can help you out with that. Anyway, that's something that we will do more often if you want. Anyway, thank you very much, Chris.
Well, appreciate that. Link to check out the site in the description field below. And again, would like to thank Reina Silver. Looking forward to having Jorge Ramiro Monroy from Reina Silver back on the show, probably a little bit later this month, and we'll get an update on how things are coming along there. But project that also has Dr. Peter McGaugh, who is the resident expert on finding large silver deposits in Mexico. So appreciate them and their support of the show, and find out more about Reina Silver at reinasilver.com. And with that said, Vince, thanks again for joining us on a Monday and talking about everything that is going on in the markets. Eventful times out there, and especially with a lot of people buying silver, as we saw from the dealers. We'll see if we're anywhere closer to that break point. But just appreciate you as always, and we'll look forward to seeing you again with whatever you find for next Monday.
That's right. You too, Chris. Thank you very much for having me, and great to see you again. See you guys next week.